Welcome back to 7-Minute Options. Let's check in on the Best Buy earnings trade that we put on yesterday. So this morning, Best Buy reported earnings before the opening bell, and as you can see here, there wasn't a whole lot of movement. Best Buy jumped as soon as the market opened, and since then has pulled back, and that's not a lot of movement if we compare that to the movement they had in the previous earnings. Back in February, they had a massive drop, and it took about 10 days for the stock to come back. Today, they had a very small movement upward, and now it has come back. So it has moved up and came back in one day, in the same day. You can see the massive volatility crush right there. If I look at the table, you can see the volatility now has come down. The volatility here is in the 30s, except for the one that's closing today. And but we stayed away from that for good reason. So there's one that's expiring tomorrow, but remember we had our position in this one in the 8-day expiration here on June 4th, and you can see the IV is down to 29%. It's actually lower there than in some of the options that are expiring later on. So that's fantastic. We had the volatility crush in one day. If I look at the position, I woke up in the morning and there it was at 6:30 a.m. As soon as the market opened, my automatic GTC order for 50 cents closed. In hindsight, I could have put it a bit lower, but I'm not complaining. This worked out very well. So just recapping the trade real quick. So here's what we put on May 26th. You can see these three lines here, and we put on, I think this cost us $126. We collected $126 in credit. And if I look at the trades that closed this morning, we paid $50 to close them out. And so the balance is $76. And of course, $3 here is transaction costs, because on Tastyworks, I believe it's $1 to open each trade. It's free to close them. So we're spending $3 on transactions. We're going to keep 73 in one day. That is absolutely fantastic. That unfolded exactly as we had hoped. And so, yeah, it's a good day. I mean, usually I have to wait like 20, 30 days to get that kind of a return. $76 on a $138 credit play. So that's excellent. That was a quick recap. And again, I wasn't all that worried. If had it gone up to the upside, we had no risk to the upside. It was just we would be collecting a much smaller net credit by closing it out for $10 or something, as opposed to 30 in profit. And had it gone down, we would have rolled it. Quick, taking a look at Twitter, because what happened in Twitter is exactly what could have gone wrong in Best Buy. So let's take a look at exactly what happened in Twitter. If I look at the history there, you can see on April 26th, I opened the 73.74 call credit spread, sold the 59 put. You can see it expired, so I let these two run to expiry, because what happened with Twitter is right after earnings, boom, they crashed all the way down. And so these I let expire because I didn't really care. Wanted to get the most money I could out of that one. And then on April 30th, we rolled from May 7th to May 21st, expiration on the 59 put, collected 61 cents. Then on May 3rd, we rolled the May 21st expiration to June 4th expiration, collected 44 cents. And on May 20th, we rolled from the 59 put to the 60 put. I actually rolled it up $1, right? And I collected 133 there. Notice that I put on an extra $1 of risk, but collected more than $1 there, which means I actually reduced my risk overall. And right now, so we've held this since April 26th. Right now, today is May 27th. And yeah, right now I've collected $364 in total credit so far, and I could buy this back today for $327. So we are actually $37 in the green, even though Twitter right now is trading for just around 58, which is $2 below my 60 put. So this is kind of like a plan, a roadmap for what to do if the earnings trade goes against you. All right, thanks very much. See you guys next time.